And joining me now for more on this market as we set up the week from Lewis, Delaware, is Eddie Ghabour. He's the co-founder and CEO of Key Advisors Wealth Management. Eddie, great to have you on the show. And perhaps let's start with this retail sales data. How does this impact your view on equities?
So I think one thing that is happening right now is we are having growth decelerate at a faster pace than the market had priced in coming into this year, us included, which is why we pivoted at the beginning of March. And usually when you start to see a slowdown, it takes a few months before it can bottom out. So we would expect the slowdown in regards to consumer spending, consumer activity, business investments to continue to slow down into the second quarter. So we are playing some severe defense right now, the most we have since the beginning of 2022, because unfortunately we think the writing is on the wall, that things are going to get worse here over the next few months before they get better.
So to that end, Eddie, let's talk about what we heard from Treasury Secretary Scott Bessent on NBC's Meet the Press on Sunday. He didn't rule out a recession, but he did note that over time, the president's policies should in fact help the stock market. How should traders and investors use that knowledge going forward?
I think investors need to listen very closely to what Secretary Bessent is saying. He's telling us, he's used terms like detox period, adjustment period. We're picking Main Street over Wall Street right now. Corrections are healthy. So what they're telling us is the capital markets, based on what they're doing, is probably going to continue to weaken, and there is no Trump put anywhere near the level that we're at. And I don't think investors truly believe that. I wouldn't call their bluff. And the main reason why is Secretary Bessent understands there's $8 trillion of debt coming due this year. $4 trillion of that is in the second quarter. What they need as they refinance this debt is they need interest rates to come down. I don't think the Fed's going to cooperate with them on Wednesday. So the only way you can get rates down to try to get this debt, which is at an unsustainable level, refinanced at lower rates, is to slow the economy and cause markets to go down, because that causes the 10-year yield to go down. That is the only way interest rates are going to go down, and Secretary Bessent understands that, and he's giving us the playbook. He's telling us to play defense during this detox period, and after the detox period, there'll be some amazing buying opportunities for the long haul. But right now, we are holding a lot of cash because we think we'll have some generational buying opportunities after this detox period.
So let's then turn to that Fed meeting on Wednesday, the decision that we'll get at 2 p.m. Eastern, as well as the remarks, the Q&A that we'll hear from Federal Reserve Chair Jerome Powell. Eddie, of course, Powell was actually appointed to this particular role by President Trump in his first term in office, but Powell has gotten pushback over time, certainly years, that he has been behind the curve when it comes to rates. How might that play into this scenario?
I think they're going to continue to prove to be behind the curve because they continue to stick to this 2% inflation number, and they don't want to pivot from it. And if they're not going to pivot from it, we're not going to come anywhere close to that without a recession, in my opinion, because core is still over 3%. I think the Fed should be a little bit more open-minded to the fact that we are higher for longer on inflation, and that's okay, and start to kind of foresee some of the slowdown problems we have and get ahead of it. But unfortunately, I don't think they're going to. I think they're going to stick to their 2% inflation. I don't think they're going to cut interest rates. And that's not going to help the market. The one thing that could help the market and kind of absorb some of the detox period would be if they started to announce QE or cutting rates now. But again, I don't think they're going to do that, and that's going to be another headwind for these markets.
Interesting. So, of course, you mentioned the detox period, the word transition. We've heard that used a lot. Some of these remarks from the Treasury Secretary and, of course, the President have been notable in the past few weeks as we've seen such a dramatic sell-off. But for people watching at home, if they didn't take swift action like you did at the start of the month in March, how should they proceed from here?
So obviously it depends upon how they're positioned. My concern is there's a lot of investors that still really heavy tech, really heavy growth. And what I would advise them to do, if this is within their playbook, is when you get these bear market bounces, because they are some of the most vicious, is to take that opportunity, to take that second chance and start positioning yourself to be able to buy dips as they get lower in the next quarter. We think we'll have these little bear bounces. We may have started one on Friday, but once we get that bounce, I think you're going to make new lows in the S&P, and that's generally how these markets play out before they bottom. I don't think we can get away with a 5 to 6% year-to-date downturn on the S&P when you're in a detox period. I wish we could. I don't think we're going to be that fortunate.
All right, Eddie Ghabour, co-founder and CEO of Key Advisors Wealth Management. Eddie, always great to see you. Thank you.